Hi, I'm James Robinson, and this is my stock pick of the week. Today's company is George Risk Industries, symbol RSKIA, and during the video I'll refer to the company as Risk. This video is the first on my 5-part series on George Risk Industries. So in this video, we're going to talk about an overview, just a look at the company, what they do, and why I've chosen to invest in them. After that, we'll do a video on operations, which is how efficiently the company delivers products to the customers. By efficiently, I mean how profitably. We're going to look at the company's balance sheet, which is a look at the company's debt and assets and how safe the company is as a long-term investment. We're going to look at the company's dividends and not only what the dividends are, but how safely they can be paid into the foreseeable future. And finally, we'll look at wealth creation. And wealth creation is how good a job the management is doing at creating wealth for the shareholders, again, over the long term. George Risk Industries designs, manufactures, and sells various electrical components worldwide. The company offers computer keyboards, proximity switches, security alarm components and systems, pool access alarms, easy duct wire covers, water sensors, electronic switching devices, security switches, and wire and cable installation tools. They also do door and window contact switches, environmental products, liquid detection sensors, and raceway wire covers, wire and cable installation tools, and various other sensors and devices. So just to oversimplify things, when you buy a security system for your house, there will be little sensors that they put on the windows to decide to tell the system if the window is open or closed. Same thing on the doors. That's an example of products made by George Risk Industries. And those kinds of products, for example, are sold to security system sellers. And their products are used for residential, commercial, industrial, and government institutions. They're based in Kimball, Nebraska, which is a small town, and they were incorporated in 1961, and they have about 185 employees. And that's, we're going to come back to that, but the fact that this company has a PE ratio of 9 is absurd. I mean, it's absurdly low. And part of the reason is it's such a small company, no one's ever heard of it. But as we go through this, I think you'll come to agree that this is just a bargain of all bargains. The company pays a 5.8% dividend. One of the things to keep in mind, though, is that dividend is paid annually, so not quarterly, and it was just recently paid. And that means you're going to have to wait quite a while to get your money, but they do pay a nice dividend. The total debt for the company is effectively zero. If you look at it on the balance sheet, it shows about $2.2 or $2.3 million of debt, but those are deferred capital gain taxes. They're not actual money that they owe the federal government, but it's not actual money that they owe a creditor. They have about $42 million in cash, most of which is in marketable securities. They're not a member of the S&P 500, and as I said, they have 186 employees. As we've discussed in previous videos, I rate every company on a score of 1 to 4 in each of 29 categories. 9 of the categories having to do with operations, 10 of the categories having to do with the balance sheet, and 10 of the categories having to do with the job that management does of securing and of creating wealth for the shareholders. So this company has a total score of 3.57. That makes it the 10th highest score of the 1,494 companies we're currently tracking. That puts it in the top 0.6% of 1% of companies. And the fact that we can buy a company this solid at less than 10 times earnings is, as I said before, and I'll say again, is just silly. I very seldom see a company with nothing in the red. The red means that it's suspect. I don't really like that about the company. In this case, the company's inventories are very high, but I think I understand why. It's a small company, and they want to have enough components on hand for whatever might happen, and their components don't age poorly. And so if it takes them 6 months to sell their components, they don't really care. They want to make sure they have supply on hand. So while I don't love that they have that much cash tied up in inventory, it's really not the end of the world. So we're going to spend some time talking about the reasons why I think you should invest in this company. I have 7 reasons why I think you should consider investing. Some of them are legitimate, some of them are just things to think about, but we'll go through each of these just to give you a sense of what I think is great about this firm. So the first section that we're going to talk about is the fact that the earnings are earning and have been growing, earnings have been growing and have been growing consistently. This chart shows you from 2006 till today. The company in 2006 was earning just under $3 a share. Today they're owning $7 a share. You can see that it's gone up. Also, if you look, it's gone up more dramatically since 2020 than it did between 2009 and 2020. So that's a good sign. This company is sort of building up steam. The CEO's been there since about 2013. To my knowledge, she is the daughter of the founder. She seems to be doing a great job. She's a CPA. And I think we can ignore that spike in 2021. That likely was COVID related. It may have had something to do with, all kinds of different things happened during COVID, but I suspect this has to do with the PPP loans, for example. But I don't know that. I haven't researched it. It's far enough back in the past that I'm not worried about it. But again, you can see these earnings are growing. The earnings per share are growing slightly faster than the earnings, and that's because they have bought back stock. The next thing we're going to talk about is the dividends and the fact that they're also growing. And when you look at this chart, you can see that they're actually accelerating. They're growing faster and faster over time. I think that's because this company has accumulated quite a bit of cash, and they're starting to see that maybe they don't have a use for it. They're not investing that cash in anything they're investing that cash in very conservative investments. They're not getting fantastic returns on that. There's nothing wrong with the returns, but they're not that fantastic. And so I think they've just chosen to pay more and more money back to the shareholders. I think it's hard for them to buy back stock because there aren't many shares trading hands, and so it's hard to make a meaningful investment. So I just believe that the reason dividends are increasing so quickly is not just because the earnings are increasing, but it's because they've made the conscious decision to start buying back or start paying back the shareholders a greater percentage of the profits. So the company is buying back shares. They haven't been buying back shares as much in the past couple of years, but they have been buying back shares. And you can see they've gone from about 5.1 million shares outstanding to, I think they're about 5.6 million or 4.6 million shares today. I would expect that to continue. It looks like they have the board has approved them to buy back another 200,000 shares. So at some point that may happen, especially if the stock was to reduce in price. But they don't seem to be in a big hurry to buy back shares. And I'm not really that worried about it because they're paying a 5.8% dividend, which effectively, as we'll talk about, is 100% of the profits are being paid back in dividends. 100%, let me phrase that. 100% of the profits from the operating business are being paid back to the shareholders. And then additional profits that are being made through the cash portfolio and investment returns seem to be left in there and compounding. The company has no debt, or at least it has no creditors that it owes money to. This does show that it has about $2.1 million of liability, but the research seems to show that that liability is not a creditor. It's deferred income tax on the capital gains that they have on the investment portfolio. That can't be avoided. That's still, in my opinion, good management, not bad management. And the fact that they don't owe anybody any money means that, to my way of looking at this, they're debt-free, which is an extremely conservative way to run your business. Next, we're going to talk about cash. And cash is one of the amazing things about this business. It's one of the things that makes it so appealing. And when we talk about cash, we also have to talk about capital allocation, because when a management is holding money that belongs to the shareholders, they have to be able to demonstrate and to prove that they're doing a great job with that money. And I would say they're doing a fair job with the money. I think they would recognize they're not getting 12 or 15% returns on the money. But I think they are just very conservatively run, and they want to have a nice buffer. And that's the way they choose to run their business. It's not the end of the world, but we do have to talk about it. So what you can see here is that the cash in 2006 was, let's call it 15 or 18 million. Actually, I think it was $19 million in 2006. Today, it's about $42 million. So that means that that cash is compounded at about 4 or 5% a year. Not great, but not the end of the world. I mean, again, these guys aren't trying to be Berkshire Hathaway. They're not trying to create a fantastic investment portfolio. I think they're just trying to be very, very conservative with the money and ensure nothing bad happens, and they have reserves so that no matter what happens, they have cash on hand. And on that front, I'm totally fine with it. I'm also okay with it because the dividends are increasing, which I think means they're making efforts to return money to the shareholders. But that is just one of the things that you should be aware of. The other thing to keep in mind is this is an $86 million company with $42 or $43 million in cash. So you're getting this operating business, which is spectacular, which is paying about $5 million of earnings. And then they're paying that back as dividends. And then they have this fortress balance sheet, which is also creating earnings, which is compounding and gradually increasing the value of the company. And that's a pretty neat trick that they're doing. Next, we're going to talk about strategic changes and things that might change, things that I think might change the way this company is handling that cash reserve. So let's get into that. This company, as we've discussed, has significant amounts of cash on marketable securities. Of the $42 million, 37 or 38 million of it is invested in securities, which is municipal bonds, stocks. They own some REIT, not very much, and then a little bit in cash. And that has two potential problems for the investor. The first one is really sort of archaic. There's an obscure law that most people aren't aware of called the Investment Company Act of 1940. It's codified as 15 USC 80A-1 or something. So without getting too into the weeds, because I'm not a lawyer, the law basically says that if over 40% of your assets are securities, then you're not an operating business, you're an investment company. And as you're an investment company, you're subject to a whole bunch of SEC draconian regulations as to how you run your investment company, because you're not running your business for the benefit of shareholders, you're running the business for the benefit of your investors. And you have to treat your investors differently than you treat your shareholders. So I am not sure why this company is able to do what they're doing, because I believe they're over this 40% threshold, and they probably have some variance that is allowing them to ignore this, but I think it's a concern. So I've looked into the numbers, and the percent of equities, municipals that the company owns are about 56% of their assets, and it looks like they have about, again, they're allowed to have 40%. So there must be something going on. And I want to stress, I haven't read this entire law. I don't know it. I'm not a lawyer. And there may be some provision that allows them to operate the way that they are. But my reading is, at the very least, they're very close to the line. So what does that mean? Let's say that it turns out that they are above 56%, and they're going to have to do something about it. They have several options. They could comply with the law, but that means they have to have a specific kind of board, and they have to have compliance officers, and they have to be audited in different ways. And I don't think they're going to want to do that. So the alternative option, and this is where it becomes interesting for an investor, is that they may have to pay a special dividend to get they may take some of those cash and market securities and sell them and pay a special dividend to disperse money out to the shareholders. And that would reduce them below this critical threshold. There's other things they could do. They could convert, for example, from marketable securities to real estate, and they could go buy some office buildings or something, and that would get them under the threshold, because when you buy real estate, it's not a security, and every dollar you put into real estate means you have more assets, and it also means you have less securities, and so that you could play with the numbers that way without spending a lot of money on real estate. My second thing is that as that money gets larger, the amount of money that they have in their cash and market security account, as that gets larger, at some point it becomes less defensible as a defensive measure, and it's more something that they have an obligation to the shareholders to maximize value. And if they're not going to pay it back as dividends, then what I would like to see them doing is being a little more aggressive with how they're managing our money, whether that's an acquisition, or whether that's, again, as you said, buying some real estate, paying back the money in share repurchases or dividends, or you spending the money for R&D. Whatever they do with the money, I'd like to see a higher return on that investment than the 4 or 5 or 6% that they seem to have been getting for the last little while. So that's sort of just some strategic concerns that I think will benefit us as shareholders. This company is very well run, and I'm not nitpicking. I'm just trying to point out some nuanced things that I think about as an investor as I look at this company. The last issue that I want to discuss, which is a reason to invest, is the concept of a sale of the business. This is a small little niche business, $86 million. It's got tons of money in the bank. It's got a good operating little niche, right? The problem is that the fact is it is a family-owned business. the Risk family has a couple of, the George Risk Industries is the name of the firm. The Risk family owns a couple of trusts, and it appears that they own about 60% of the stock. So they're going to do what they want to do running this business. You have to appreciate and approve of the way they're doing it, because no Carl Icahn is going to come in and tell them what to do or boss them around. You either like the way they're running the business and invest, which I've done, or go find some other investment. But one of the things that could happen here that might be a catalyst is Stephanie Risk has been running the business for about 13 years. She took over from her father. She's the I think her name is Stephanie Risk McElroy. But she took over from her father. She was, I guess, the CFO. And she's been doing a great job running the business. But I don't know how long she's going to want to do it. And one of the things that happens with family businesses often is there's no next generation to take over the business. So if she decides that she's had enough at some point, which she might, I suspect that the most likely option here is that they would sell this business to somebody who has the management expertise to run it, and the family would cash out then. That could be a very good thing for the shareholders, because this stock is currently trading at 9 times earnings. I think if it was to sell, it would sell at a significantly higher multiple than that. And even at 13 times earnings, we get a 50% return on investment, right? So again, one of the things, I don't really necessarily believe there's going to be a big problem with this 1940s Investment Company Act, and I don't really believe they're going to sell the business, but I believe either of those things could happen. The better thing is it's well run, it pays a 6% dividend, they buy back a little bit of stock, they have a ironclad fortress of a balance sheet, and they're increasing their earnings. So those are all reasons to buy the company. The strategic changes and the sale of the business are just potential upsides. So there are some concerns that you should think about as you're looking at buying this company. The first one is the company has very low trading volume. And so if you had a sizable position and you wanted to get out, you're not getting out. I mean, it's going to take you, in our case, it would take us a month or two to sell our shares, maybe more. And so you just have to, when you buy this company, you have to say, I'm perfectly happy owning this company for, a very significant period of time. This isn't something I'm going to jump into and flip out of. Although, again, I reserve the right, I could sell any of my stocks at any time for any reason or no reason, but that's not my intention. This next thing is the bench. I don't know how much executive talent, how deep this company's bench is. They appear to be in a very, very small town in Nebraska, and I just don't know that there's a bunch of management talent in a town of a few thousand people, in Nebraska. And so, again, if something was to happen to Stephanie, or if she was to just decide she's had enough, I don't know how this business continues on and continues to prosper, because it's not easy to find good managers, and I don't know how easy it is to recruit a good manager to replace the current CEO. While that means there's a likelihood for a sale, it also means that it is something you should be aware of, that the bench just isn't very deep. The final thing to consider, I don't consider it a negative, I consider it a positive, but this isn't basically a family business. And if you buy shares in this company, you're effectively a silent partner. You're not going to have a say. You're not going to control what they do. But frankly, they're doing such a great job, I don't know why you'd want to. I think you stay out of their way, you cash your dividend check, you tip your cap to them. But if you're somebody who goes in and says, hey, these guys have way too much cash at $40 million, and we should get them to give $20 million back out to the shareholders, and we're going to, write letters and do proxy. None of that's going to happen, and none of that's going to work. You have to be pretty comfortable with the way they're currently running the business. So that's it for the fundamentals on George Risk Industries. I hope you'll agree it's an interesting company. It's a very small company, but it's worth taking a look at. My name is James Robinson. Thank you for your time.